Obviously, stores have been open for a couple of weeks now, and the general feedback we're getting across the board, across many categories, is that it has been reasonably strong out there. Even in terms of car sales, where we're into a deep, dark 3-year downturn. We've spoken to a range of independent kind of unlisted players that have said the last couple of weeks have been quite buoyant. Even spoke to one person yesterday where they said, they haven't been this busy in some time. Obviously, a chunk of that's probably coming from commercial sales as opposed to, retail sales, given the tax incentive is material this year, $150,000. That's meaningful for these businesses. So anyway, it's all business, and that's quite positive. Many of our retailers kind of conducted trial store openings about 3 or 4 weeks ago, and then obviously after that announced that they would open their store doors. My best guess at the moment is that trading is probably exceeding expectations across the board. Just a couple of things to note. I guess after spending 7 or 8 weeks at home, people are willing and get out there and spend after spending nothing in their homes for some time. So certainly we're seeing some catch up on pent-up demand, I suppose. Plenty of taking the opportunity to access that $10,000 of super. Again, that $150K of instant tax write-off, providing SMEs have tax to offset that with. And obviously JobKeeper, so plenty of casuals out there. Aside from JobKeeper obviously being very beneficial for corporations, plenty of casuals out there are actually earning more than they did before COVID. So as best as I can understand, casuals typically earn around $450 to $500 a week. They're now getting $700, and there's some nice discretionary, spend coming back into the market, which is helping too. So as far as I can tell, I think this kind of activity will last for at least another month or two. The key test, obviously, for all these businesses will be come October, when they have to start paying, their staff, and also have to probably make good on a bit of this rent that they haven't been paying. And then, of course, in that context, what sales deficit is running at come October. So when I talk about activity, really picking up, I'm not saying that comp sales are necessarily positive on this time last year. That would be a very big jump, but certainly probably up on base case assumptions. So obviously the extent to which the unemployment rate in Australia peaks, we probably won't know until the wake of JobKeeper ceasing. Unemployment highly correlated with discretionary spend. We will be keeping a close eye on that. So I do think after this big rip we've seen in retail, the market will potentially become more cautionary and wary of the sector come about September as we come into the cessation of JobKeeper, because there is a good chance that JobKeeper plus these deferrals of rent are distorting things somewhat. JobKeeper is saving my companies millions and millions of dollars per month, so we need to keep that in context. So when we get to that September period, I think the market will be more at ease with those stocks that have been able to trade and keep their stores open throughout COVID and have actually not had to tap JobKeeper. And unfortunately, they're the expensive ones: JB Hi-Fi, Super Retail, Domino's, Bapcor and Collins Foods. But until then, we've got plenty of months to go until then. I actually think earnings risk at the upcoming reporting season does lie to the upside, given two things: stores are open and that access to JobKeeper is saving them a fortune. So you've actually been seeing me upgrade forecasts, you've been seeing consensus upgrading forecasts in this space, and I actually think risk still does lie to the upside for this reporting season. Couple of other things just want to touch on. Obviously, we won't be travelling overseas for some time. That's a big part of, the average Australian's spend, aside from potentially going to New Zealand. So there will be a big shift towards domestic services and products in terms of expenditure over the next 12 months at least, I would have thought. A couple of trends I'll call out. Obviously, nesting spending on the home, that is 100% real. Drove out of my home this morning. There's about 12 Hiluxes parked up the street, everyone doing something around the home. That's a benefit, obviously. JB Hi-Fi, Beacon, Wesfarmers, Harvey Norman and Adairs, to name a couple. More time on the road, less public transport, less offshore travel. That is a real trend. There we have AP Eagers, Bapcor and to a lesser extent Super Retail Group. Domestic tourism, there aren't unfortunately a lot of ways to play this, given so many have been taken out, but obviously Apollo, that's having a real rip off the lows. A lot of market interest in that stock at the moment. It is a micro cap, but it is probably as pure a beneficiary as you can get. That said, remember that 70% of their customers previously were coming inbound from offshore, so a surge in demand domestically really needs to happen to kind of offset that, but clearly a beneficiary. And Super Retail Group as well. Store rollouts given online is ramping up and accelerating quickly. Store rollouts are a thing of the past now for retailers, really. We've been talking about this for years, but the ones that do still have it will command a higher premium than you've ever seen before, and that's where you have, the likes of Lovisa, Baby Bunting, Domino's and Collins Foods. I just wanted to touch on a couple of charts here. We always look, and we've missed the retail sector, looking everything's up 200%. A lot of things are off the lows, but always good to keep in context how far they still are off their highs. And I've circled a bit of a bucket there. The likes of AP Eagers, Modos, Lovisa, Nick Scali's and Adairs and Beacon is all still well and truly 30 to 40% off their highs. If you look at it another way, and I'll delve into this a little bit though, you can see on that far right-hand corner, this is basically, I've gone back to calendar year 19 EPS and looked at the PE they'd be trading on today versus the average PE they traded on during calendar year 19. So, I think that's the best way you can compare it to, because we have no idea when we're going to get back to peak earnings again, but let's look back at calendar year 19. So a lot of these stocks have had an almighty rally and are not trading far off, what they traded on, last year, and it arguably will take us some time to get back, to those earnings levels. And then if you look at it another way, some of these businesses have benefited and obviously we've factored in EPS being higher this year. So you can see there that it's no surprise that those key defensive and beneficiaries like JB's, BAPS, Buntings, Domino's and Collins are all trading at premiums to where they did last year. So if you look at, kind of think about key picks, they're really changing up a bit. Some of these things have rallied hard, Baby Buntings and JB Hi-Fi's, etc. So I'd say today, if you look at that chart I had earlier and you think about, quality of management, balance sheet, earnings trajectories, I'd probably say my preferred picks would still include a Bapcor, AP Eagers 100%. You need to have patience there, but I think you'll be rewarded handsomely, and it's starting to move quite quickly. Adairs I'm still very happy with. Beacon obviously been quiet, and we know they're probably faring pretty well. Motorcycle Holdings, on a risk-reward basis, it's nearly doubled off its lows, but it's starting to look interesting. And JB Hi-Fi, look, I think potentially their profit will be absolutely enormous this year. We've heard from landlords in certain centres that it's still like Christmas every weekend in their stores, and they're certainly benefiting from this tax incentive, tax write-off incentive. So we've got that on a hold, but I wouldn't be selling it. I'll just lastly finish on Lovisa, which is obviously the best, or one of the best retailers I cover. It has had a massive run, obviously off the lows, but still 30% off the highs. As we know, 95% of their growth comes from rolling out stores offshore. So at the moment, you're being asked to pay a pretty good premium, a pretty big premium. I have no doubt that a $20 average basket size will bounce back really quickly. I have no doubt that their average customer probably won't care too much if there's a recession or not, if we actually do have one. And that lastly, you just want to kind of know how quickly they can get those stores back up and running. Obviously, international travel restrictions will prevent Shane Fallshear from travelling the world, as he does every single month of the year, but he does have large support teams who have been stood down in most of those global territories. But, internationally, global commerce will continue without people having to get on a plane. He will have tens and tens and tens of leases in the pipeline ready to get going, but he will not sign up on those leases until he gets, the rate or I guess the terms that he is looking for. So there is a chance that takes us a bit longer to get back there, but I have no doubt it will. And the silver lining here is you will get better lease terms for this business. And as I said, I think this business will command an even higher premium than we saw pre-COVID, because it will be one of the few ones that are actually rolling out stores, waking up every day and growing by 20% by opening new stores.